Another stock crashing after earnings. Today, we're looking at Cisco Systems Inc., ticker symbol CSCO. You can see it's down almost 15% after hours to $41.30 a share. It was $48, and the reason for this is they've just have released their latest earnings for Q3 of 2022. So what we're going to be doing is going through these earnings, then looking at my discounted free cash flow model and Buffett Graham intrinsic value models to see if this stock is a buy. So before we get into that, can you please give a like on the video, subscribe if you're not already, and let's get on with the video. The stock is down 23% year to date, but obviously be a bit down more than that. With these earnings, the market's not enjoyed it one bit. Over the last 5 years, it was up 55%, down from its recent highs of $62 a share. But if you've been an investor in Cisco since back in the day, it was, I can't even get to it, almost $80 a share. So even since then, it's down 39% from its all-time highs and a little bit more. But is the stock undervalued at its current price? That's what we're going to be looking at right now. So let's have a look at the earnings. We have the statement of operations here. We're looking at the revenue. They have the 3 months ended and the 9 months ended. Won't be talking about the 9 months ended too much here. It's more on the 3 months because that's the most recent quarter. And what has happened with revenue? Well, revenue is relatively flat, 12.8 billion to slightly over 12.835 billion. You can see both a slight increase in the product side, but services is a slight decrease, which is quite rare for companies right now. Normally their service sector, when I was looking at Apple, that was booming. Microsoft is booming, but Cisco relatively flat and in fact decreasing. So what does that mean? Well, we've got 12.8 billion in revenue for the trailing 12 months. 12.3 billion in the previous quarter. So what does that mean for the trailing 12 months of Cisco? That actually gives us a figure of 48.1 billion, which is slightly less than it was in 2021. So that is decreasing revenue. In fact, the lowest it's been in the last 4 or 5 years since 2018. 43, 51, 49, and 49, and we're now at 48. So that is decreasing revenue. Next, we're going to be looking at is the profit of Cisco and how we get profit. Well, it's net, revenue minus all the costs. You can see costs are once again up a little bit, but not massively. So overall, the net income is actually up 2.8 billion to 3 billion. And if we go into Yahoo Finance again, what does that mean for the profit on the trailing 12 months? Well, we've had very down in 2018. I'll take that as a bit of a blip here, but 11.6, 11.2, and 10.5. Well, profit is actually up to 12 billion. So that is a good sign for Cisco. Revenue is decreasing, which is not what you want, but they've managed to generate more profit from that revenue. Now we want to be looking at the shares. Are they buying back their shares? And my gut would be yes with Cisco, but they did previously issue more shares. Turns out that was a good idea because their stock price has dropped a little bit, but now they're buying back shares, which is rewarding investors. 4.2 billion to 4.152. So that is decreasing. And finally, we want to look at free cash flow. How do we get free cash flow? Well, it's cash from operations minus capital expenditures. Cisco have been a little bit naughty here. They've only put their 9 months ended, not their 3 months. But if we look, you can see net cash from operating activities is down in those 9 months, 10.9 to 9.5, and capex is relatively flat. Acquisitions of property and equipment. But if we go to the very top here, they will tell us what their free cash flow is actually for the quarter. And you can see if I look from, cash from operating activities is about 3.7 billion. So we know it is about that. And if we go back to Yahoo Finance and look at the cash flow, well, Cisco has been a cash flow generating monster, has a lot of free cash flow, 12.8, 14.9, 14.6, 14.7. But saying that once again, free cash flow for the trailing 12 months is down 13.7 billion, which is the lowest it's been since 2018. So this is not looking good for Cisco, and that is probably why, as you can see, it is down almost $7, which means it's at $40 a share, which is the lowest it's been actually if we take this back since, well, what, pre the COVID crash was about these similar times, around about here, back end of the start of 2020, when it was a lot lower and then dropped back up and then dropped back down. So it has lost a lot of gains in the most recent time. In fact, if you go back to 2018 was when it was probably about consistently $40 a share. But is this the right time to buy? Are you buying at a good opportunity here? Well, let's have a look at my discounted free cash flow model. So firstly, what are we looking at here? Well, we've calculated the future free cash flows of Cisco, and discount them to today's value. And yes, I think this will like the stock. They normally do $102 a share, which is 112% than what it currently is, with $48 a share, or $40 a share. In fact, it's a little bit higher. Now, this is increasing free cash flow. This is using averages, but let's just have a look and see. This was a comment on my previous videos. If this is decreasing free cash flow, so let's just say that the revenue growth is slowing. Now, Cisco said that they're expecting 2 to 3% revenue growth over the next few years. So we've lowered the averages here, but let's lower this number here to 114. And let's also change, let's see what that does. That's $91 a share. And let's just see that it decreases even more. Let's go 90%. $72 a share. So even if it's decreasing in 2023 and then slightly steadier, then it is still undervalued based on discounted free cash flow models. Now, let's undo this now. So we go back to the original numbers we had. Averages, that's Walmart. We don't want to see what Walmart is. And then have a look at the Buffer Graham intrinsic value model. That actually has the stock at $65 a share, which is a 35, or in fact probably a bit higher now, percent discount. So both of the models are saying it's a buy, but these prices are quite high. If we go back to the share price over there, it's only been over $60 a share briefly, and this was in the most recent time when it had its high at back end of December, before the sort of market really did slow. And then before that again, it was in the 2000 tech fall. So yes, fundamentally very good company, but slowing revenue is definitely a problem, or declining revenue for that matter. Right guys, thanks for watching. Please give it a like on the video if you enjoyed it. Subscribe if not already, and I'll catch you guys next time.